Today we're diving into one of the biggest shifts in U.S. tax compliance in years. That's the IRS's new digital asset reporting regime. This regime will be rolling out through 25 and 26, and you'll be hearing a lot about a Form 1099-DA. If you hold crypto or accept or trade or even move crypto between wallets, these changes affect you. Welcome back to Facts, Figures, and Fallacies from the Front Line, where we break down the changes that matter most to small business owners, investors, and professionals navigating today's challenging regulatory landscape. I'm your host, Mitzi Sullivan, founder of the channel and CPA for over 30 years. The IRS has laid the foundation for a major overhaul of crypto reporting. And 2026 is the year that everything goes fully live. New regulations finalize a shift that treats digital asset brokers just like you would treat traditional brokers. Starting in 2026, custodial crypto platforms will be required to report both gross proceeds and also basis for many digital assets, similar to the equity reporting rules. This change follows a phased rollout. So this rollout began in 2025. For 2025, brokers were only required to report gross proceeds. Then in 2026, the brokers will be required to report gross proceeds and also cost basis for covered assets. So what's the IRS's goal? Of course, more transparency, fewer mismatches, and of course, improved compliance. Because digital assets are becoming increasingly more mainstream, but reporting requirements just have not kept up. Starting in January 2026, digital asset brokers will be required to issue the new Form 1099-DA, digital asset proceeds from broker transactions. This form will report every crypto sale you make, every taxable transfer, the destination wallet for those transfers, the asset type and value at the time of the transfer. So you can see quite a bit of transparency that did not exist before. It reports wallet addresses, proceeds, and activity that can help map digital asset movement across platforms. But here's the kicker. The IRS gets big numbers without basis in year one. So that can look like large gains unless the asset holders report their cost to basis. So you will be receiving 1099 DAs. You will be required to report those sales or transfers, and you will be responsible for providing documentation for your basis in those assets. And the penalties will be the same as they would for any other failure to report 1099 income. So you can expect CP 2000 notices, audits, and high assumption tax bills. So let's look at what's actually in the final regulations. These rules apply to custodial brokers, which include crypto exchanges, hosted wallet providers, kiosks, some payment processors. These brokers must report gross proceeds for transactions that occur after January 1st, 2025, and gross proceeds and cost basis for some transactions after January 1st, 2026. They will also be required to report real estate transactions, fair market value of any cryptocurrencies that were included in a real estate transaction after beginning in 2026. They will be required to aggregate report certain stablecoin and NFT transactions if they're small enough to meet certain de minimis thresholds. And then notably excluded from reporting requirements, for now at least, would be non-custodial and decentralized brokers. There is a plan to have a separate regulations for those platforms. So tax professionals are stepping into a brand new compliance era. You will have on-chain and off-chain reconciliations that must agree. Wallet by wallet accounting will become mandatory. And then those 1099 DAs will identify any mismatches automatically, similar to the 1099 NEC that we have today. Let's look at some key shifts. These would include no more universal accounting methods, a requirement to use the FIFO or specific identification methods. There are also transition rules for switching to wallet-based accounting. You may experience missing bases for assets moved between platforms. And then you will definitely see an increase in enforcement using machine readable reporting data. So for CPAs, this will mean more reconstruction of transaction histories with a lot of information that may be missing. Definitely more audit prep documentation and much more emphasis on tracking on inside and outside exchanges. So if your clients move transactions off exchange, that exchange will report the transfer out. And now the IRS sees the destination wallet. So for businesses and individuals that had crypto sales in 2025, here's what you can expect when you receive your 1099 DAs early in 2026. These exchanges will not give you complete cost basis. So if you get in there and report your 1099 gross proceeds and don't pick up your cost basis, that will all be counted as gain. So you will be responsible to go back and calculate your cost basis on any crypto assets that you sold beginning in 2025. You will also have to keep transfer logs because any transfers that you make between wallets will be reported on a 1099 DA. So you will have to explain where that money went, that it was not a sale, and that there were no gains. So it's a really good idea to go ahead and construct your transaction details now for all of the crypto assets that you currently hold. You're going to want to keep up with the basis that you have in those assets because the enforcement is increasing. When you sell those assets, you will get a 1099 DA that will report the gross proceeds, but it will not accurately report your cost basis because it's only picking up that basis beginning in 2026. And collecting that basis information is definitely something that you do not want to put off until you're getting ready to file your tax return, because the CPAs will be very busy near the deadlines, and compiling this information can be very time consuming. So let's look at what this means for businesses that have begun accepting crypto. If you have received any crypto 2025, 2026, you're going to report that crypto just like you would cash, but at fair market value on the date that it was received. So your cost basis on that crypto will begin on the day you received it at fair market value. If you hold it for a year, maybe you have a gain or loss over that year period, but your basis will be the fair market value of the asset the day that you received it. And any sales or exchanges later will be reported on that 1099 DA, so you will need your basis. And the transfers out of your account also will appear on the 1099 DA. For brokers in real estate transactions, it will be very similar. They will report any crypto used in the transaction at fair market value on the date of the transaction. So crypto is not the Wild West anymore, at least from the IRS's perspective. With that 1099 DA, regulators will have full visibility into digital asset activity. And that means there will be an increased expectation for defensible positions in crypto gains and losses. So more reporting means more accountability, and the IRS will be expecting very accurate, defensible documentation. So if you're a business owner, a CPA, or crypto trader, begin preparing now. Your 2026 tax season will thank you. Thank you so much for joining me today. And if this helped clarify the new rules, please follow and share, and feel free to reach out with any questions that you have while preparing your 1099 DA information. And until next time, stay wise, stay compliant, and stay ahead.